Hey guys, welcome back to the Avoiding Broke podcast, where every week we give you more of the tools, techniques, and ideas to help improve your money and your mindset. So guys, today this for me is really our quarter two, Q2 property investing and purchasing update. I'm just going to cover some of the key thoughts that we've got here at Team Avoiding Broke in terms of looking at the property market, mostly in the UK, a little bit overseas, and just thinking about what are we actually seeing that is going to influence our decision to kind of get into the property market, be it on a residential basis or as investors. So guys, you may have seen and heard that in the UK, our property market right now is really quite buoyant. So about a month and a bit ago, the Chancellor Rishi Sunak basically announced a stamp duty extension, which effectively gives people buying properties up to £500,000 a little bit of stamp duty relief. And then that amount of relief is going to kind of taper down over the next few months. So what does that mean? Well, it's meant that anybody who's buying a residential property could be saving a decent amount of money. Anybody who's an investor buying a buy-to-let property saves on what's called the stamp duty surcharge that you pay. It's an amount on top of what residential buyers are paying. So what that's been great for is economic activity in the housing market. And a big question that you see a lot on the investment side now particularly is whether or not, with the tapering off of the stamp duty relief, whether we're going to see a drop in activity. And kind of thinking, well, how do we make our decisions about whether or not to get into the market? So guys, here at Team Avoiding Broke, we are very big on fundamentals. So when we think about whether to get into the property market, you think a lot more long term as opposed to what is the current government policy and what does it really mean for us. I mean, that's obviously relevant, but it's not as simple as saying if the stamp duty relief goes, then all activity stops. Guys, what's really important to understand at the most fundamental level is that over the course of time, when you discount for things like the stock market, property and land has created more millionaires than any other asset class. Arguably more so than the stock market, but I think you tend to sometimes be a little bit slower to actually see just how many property multimillionaires there actually are. The reality is that property wealth is not always realised immediately. So it's not the case that you can necessarily pick up a phone, look at an app and you always see it there. But when you look at things like cash flow, when you look at things like equity, property has created a huge amount of wealthy people. And when you look over the course of time, more people have generated more wealth from holding property than from any other asset class, which is phenomenal. So the core fundamentals are fantastic. The other thing to remember, guys, is when we think about alternatives. So if, for example, you've got £100,000 or $100,000 right now, we could have a conversation and you say, well, Jamain, I'm not sure where to put this money. And I think, don't just look at the relative benefits of property, but also think about what are your alternatives. If we look at the macroeconomy right now, arguably the alternatives aren't that great. So for anyone who's looking to just hold cash, well, we know that cash is basically useless until it's put to work. Why? Because of inflation. The gradual rise of the cost of goods over time means that if you've got £1 today, it is worth less in the future because that same £1 can buy fewer goods. So really and truly, holding cash is not looking like a great viable alternative. I think moreover, the fact that you've got a lot of governments printing money right now, it should be causing us to ask more and more whether or not cash remains sensible. I think when you look at the stock market, well, anyone who's been tracking it, we've seen quite a lot of movement in the last kind of couple months. I think the last week was actually particularly good, certainly for the FTSE, maybe for the NASDAQ as well, and any other indexes. But the reality is the predictability is incredibly low. Like if you look at a lot of tech stocks right now, I mean, tech stocks have been absolutely buoyant over the last couple of years. Right now, you're not seeing the same level of confidence and return that you would have seen in previous years pre-COVID. So the actual potential to generate the returns you're looking for and that stability may not be there. We've spoken a lot on this channel about cryptocurrency before. Guys, the general outlook is not changed. Crypto remains high risk, potentially high reward. I think it could be a fantastic asset class because more and more people are moving away from centralized systems of governing money and controlling money and ultimately printing fake money to a more decentralized system where actually the people have got a little bit more control over the asset class, and it may represent stronger economics, but also in a digital world. And that's really important because if we look at the world that we live in now, it's a digital world, it's not an analog world. So crypto could be fantastic, but always think about it. But when you actually start paring all of this stuff back, the true alternatives to actually putting your money into a solid piece of property, they don't actually look that great. So I'd strongly argue that the fundamentals about property as a great investment class right now, great investment asset class right now, they remain absolutely fantastic. I think we need to be aware of things like stamp duty relief that you're seeing in the UK. You may have different equivalents over in the States. We've got to be aware of it, but let's not forget that no matter what happens, property in itself is still great. One tactic that you should definitely be looking at right now is if you want to buy now, start pricing in reductions based on stamp duty relief. So say, for example, you're getting in the property market right now. You may not be in time to get the full suite of relief that's going to be happening around the summer. Well, you can actually start negotiating discounts on the property you're purchasing in order to start pricing in that discount. Even if you're going to kind of meet somewhere in the middle, I think you're going to find a lot of sellers are going to be willing to kind of get a sale rather than lose a sale. They're going to be willing to kind of negotiate a little bit more on price. That could be phenomenally helpful. I think for a lot of us, we're going to have to think really carefully about location strategy as well. So what you saw was typically prime town real estate used to be phenomenal. But if you look right now, guys, anybody who's thinking, for example, about London as a property market, well, arguably it's giving us kind of two really interesting parallels. So on the one hand, you've got the ultra luxury, ultra high-end property, which has still been incredibly buoyant. I think it's pretty much an example of a Giffen good, whereby its value can kind of increase disproportionately with what may seem like tapering off demand in other places in the market. So actually, the value of prime London real estate, despite the fact that we've been in a pandemic, has actually been performing really well, and demand is certainly very high. So we need to be aware, guys. You've got that one really prime end, but there's another end of actually less prime property in London, which, when you actually think about why it's so valuable, well, if you've got fewer people, say, going to offices, more people working from home, you've got fewer businesses that might be open and thriving, there's a really important question about whether or not that property still remains attractive. I'm not too sure. We've seen in the UK, for example, more and more financial institutions are starting to tell their staff, work from wherever you want. You don't need to necessarily come back into the offices. Well, what that means is it's going to have an effect on those head office locations where you used to see a lot of industry concentrated. That's going to start moving out to the regions. Because as you see more regional offices pop up, or as you see more people flocking to where they want to have their homes, that's where you might start seeing more and more emergent local economies. So guys, the big bet that I'm going to be making, and that team Avoiding Broke are going to be making, is that we may see a tapering off of demand in London and the suburbs, and we may see a much bigger spike in demand elsewhere in the UK. Not necessarily in big towns, but big residential areas where you might see them previously called kind of commuter towns. Those, I think, are going to be amazing opportunities for investment. So we're going to be looking at those smaller towns where we can see you're going to have large houses, families settling, and you might want to have a really nice amount of green space and big homes. That's where we think the investment potential is going to be. That's where I think we can capture some upside. And of course, the benefit is it's already kind of priced well. So if you're previously a London or Greater London investor, you can take your money out, much further out in fact, and maybe get 2 or 3 properties for the price of one in Greater London. That's a huge return, guys, huge opportunity. And if nothing else, it means you're going to spread your risk. So importantly, when you've got those 3 properties in your portfolio instead of 1, even if you're not earning rent on 1 property, you've still got the other 2 that can hopefully cover you. So there you have it, guys. That's the nub of our current investment outlook. I mean, rather than call it Q2, maybe it's better to call it an April investment outlook, because I'm sure the view may change next month. But we still think property is really resilient and robust as a phenomenal asset class. We still understand that property right now, if you compare it to commodities, if you compare it to cash, if you compare it to the stock market, right now, property yields are arguably giving you better returns than any of those alternative asset classes. The only example that bucks the trend is probably going to be cryptocurrency, which is a new and emerging asset class, which I highly encourage people to look into. But property remains phenomenally resilient. And I think if you can tailor your investment strategy, not to focus just where you've been looking previously, but to actually step out a little bit more and move into those locations that are going to be giving large homes, family homes, green space, probably houses over flats, maybe not even necessarily HMOs, but single family lets, or even potentially developments where you can maybe get in to buy a block of flats or a small development of houses. I think those could be incredibly high yielding, but also very, very resilient, because you're going to be catering for people's need to kind of have that open, clean, green space, but not necessarily be living too much on top of other families. And that's the bet, guys. I'm going to be very carefully looking at those options to kind of make our investment moves. And I definitely want to hear from any of you who have got some other thoughts. So as ever, guys, you can find us on all media platforms at Avoiding Broke. Email us at avoidingbroke@gmail.com, or leave a comment if you're watching this on YouTube. Other than that, guys, have a fantastic weekend ahead, and we look forward to seeing you next week. Till then, guys, you take care, look after yourselves, and have a blessed week. Take care. Bye.